Welcome to the NiftyNoon podcast.
Glad to be here.
So imagine discovering that the steel vault holding your life savings has this microscopic flaw, right? A flaw that was actually manufactured 3 years ago.
Yeah.
And an AI just handed the exact blueprint of that flaw to a hacker.
It's terrifying.
It really is. For you sitting at the table with us today, we are skipping the shallow end entirely in this deep dive. We are looking at a week defined by a massive collision.
A huge one, yeah.
It's this collision between institutional infrastructure hardening, where traditional finance is basically swallowing the yield curve and just raw, unadulterated on-chain turbulence.
Exactly. And, before we really tear into the mechanics of what actually happened this week, let me just give you the high signal briefing.
GLDR.
Right. The core structural shifts you need to navigate this market. So first, AI-driven code analysis is actively weaponizing open source history.
Wow.
Yeah, it's permanently altering the risk profile of hardware self-custody. Second, traditional finance, they aren't fighting stablecoins anymore.
Right, they've pivoted.
Completely. They're aggressively positioning themselves to capture stablecoin reserves through these new tokenized money market funds. Third, Washington's political gridlock over ethics has severely derailed America's crypto market structure legislation.
Leaving a huge vacuum.
Exactly, which global players are more than happy to fill. Fourth, Ethereum is facing this internal economic civil war over staking issuance.
That one is getting really heated.
Oh, it could upend the entire decentralized finance yield curve. And finally, the DeFi heavyweights, the decentralized exchanges, they've realized the real money isn't just in hosting a trade.
Right.
It's in monopolizing the entire token birth and life cycle.
That's a phenomenal setup. So let's start with that first structural shift, because the market entered this week gripped by just a wave of pure anxiety.
Pure panic, honestly.
Yeah, it felt like the core ethos of this space, the idea of absolute self-sovereignty, took a direct hit with this Coldcard hardware wallet exploit.
It did.
We are looking at nearly $89 million drained. That's over 1,360 Bitcoin swept across more than 4,500 addresses.
Staggering numbers.
And the terrifying part is the origin, right? Because this wasn't a phishing scam. It traces back to a latent firmware flaw from March of 2021.
Yeah, it's a chilling development, and we really need to look at the exact mechanism of failure here because it's important for you to understand.
Break it down for us.
So, when you generate a wallet, the most critical element is true entropy. Absolute randomness. That randomness is what generates your seed phrase.
Right, like rolling physical dice.
Exactly. Secure hardware wallets are supposed to pull that entropy from a dedicated, physically isolated hardware chip. But in this specific 2021 firmware build, a bug accidentally routed that generation process away from the physical chip.
Oh, man.
Yeah, it routed it into a predictable software randomizer instead. And because a software randomizer follows a deterministic mathematical pattern, the attackers could essentially reverse engineer the entropy.
So they just reconstruct the private keys offline.
Exactly, completely offline.
So the device basically thought it was pulling a random number from a physical roll of the dice, but it was actually pulling from an algorithm that had a highly predictable sequence.
Yeah.
But what really caught my attention was CoinKite's CEO pointing out how this was even discovered.
Yeah.
He noted that AI-driven code analysis likely allowed these attackers to comb through years of open-source firmware.
Right.
And they found this latent bug exponentially faster than any human security team ever could. It's kind of like an AI acting as a master structural engineer.
Oh, I like that analogy.
Yeah, it's like scanning millions of building blueprints in seconds just to find one single high-rise built 3 years ago that's missing a critical load-bearing beam.
That is the exact right mental model. And the implications are just staggering. I mean, we've operated under this assumption that if open source code has been heavily audited and it's been live for years without being exploited, it's fundamentally secure.
Right, the test of time.
Exactly, but AI code analysis just shatters that assumption. It's actively looking for topological flaws in the logic that human auditors simply cannot perceive.
Which totally explains the brutal market reaction on Monday. I mean, we saw sub-1 Bitcoin daily transfers to centralized exchanges just absolutely spike.
People were terrified.
Yeah, retail holders were sweeping their hardware wallets in a panic, sending funds back to centralized entities at levels we haven't seen since the FTX collapse in November 2022.
Which is saying something.
It really is. And this anxiety was compounded by macro jitters in the background. I mean, MicroStrategy dumped over 1,600 Bitcoin. Trump Media sold over 2,600.
Right.
And then the prediction market, Kalshi, got slapped with a $36 billion lawsuit in New York. The psychological safety net was just gone.
The panic was real, but, as sophisticated investors, we have to separate the signal from the panic here.
Okay, so what's the signal?
This was a vendor-specific hardware bug. It is not a fundamental flaw in the Bitcoin protocol itself.
Right, very important distinction.
And it doesn't invalidate the concept of self-custody. However, the second-order consequence is massive. If AI can find a 2021 bug today, single-signature hardware setups are just no longer a viable security standard for serious capital.
You need backups on top of backups.
Exactly. It drastically accelerates the necessity of multi-signature arrangements. You have to distribute trust across entirely different hardware manufacturers and architectures, so no single firmware bug can compromise everything.
Well, that perfectly sets up the massive contrast we saw unfold next on Tuesday, because while retail users were frantically fleeing self-custody out of fear, Wall Street institutions were quietly launching heavily fortified institutional-grade on-chain vaults.
They certainly were.
Let's look at BlackRock, deepening its footprint in tokenized real-world assets, right? They just launched 2 new on-chain money market funds. We've got the BlackRock Select Treasury-Based Liquidity Fund.
The BSTBL.
Right, launching on Ethereum with BNY Mellon.
Yeah.
And then there's the BlackRock Daily Reinvestment Stablecoin Reserve Vehicle, a multi-chain fund with Securitize.
It's just a masterclass in strategic positioning, really. These funds are investing in cash, short-term U.S. treasuries, overnight repo agreements.
Safe, yield-bearing assets.
Exactly. The real-world asset market has already grown 200% over the past year, surpassing $30 billion. But BlackRock isn't just trying to offer another tokenized treasury product to retail.
Right, there's a bigger play.
A much bigger play. These specific funds are engineered to act as eligible reserve assets for stablecoin issuers under the framework of the incoming Genius Act.
Okay, let me push back on this architecture for a second.
Go for it.
If major stablecoin issuers start parking their billions of dollars of reserves inside BlackRock's tokenized overnight repo agreements, aren't we just inviting traditional financial contagion directly into DeFi?
That's the big fear, yeah.
Right. Because if the repo market freezes up in TradFi, suddenly the underlying reserves of on-chain stablecoins are compromised. Are we just rebuilding the exact same fragile banking system but slapping the word on-chain on it to make it sound innovative?
It's a highly valid concern, especially regarding the transmission of contagion. But you have to look at the economic incentives driving this from Wall Street side.
Okay.
Traditional finance has realized they cannot kill stablecoins, so they've decided to capture the yield instead. If you're a massive stablecoin issuer, you require your reserves to be highly liquid, incredibly secure, and completely compliant with incoming legislation like the Genius Act.
And Wall Street provides that.
Precisely. By offering tokenized money market funds that meet those exact regulatory criteria, Wall Street effectively becomes the foundational bedrock of crypto liquidity.
Wow.
They are swallowing the yield curve of the digital economy. They build the compliant pipes, and crypto flows through them.
And we're seeing that global plumbing get connected everywhere. On the same day, Western Union stablecard went live, which is fascinating.
Massive deal.
Yeah. I mean, they process $100 billion a year in remittances. And now that money can move on-chain, arrive as a stablecoin, and be spent instantly anywhere Visa is accepted.
The adoption is real.
But here is the friction point. All of these massive institutional moves, from BlackRock to Western Union, they rely heavily on regulatory clarity. And right as the industry was building momentum, that legislative clarity hit an absolute brick wall in Washington on Wednesday.
We're talking about the Clarity Act, which was arguably the most comprehensive market structure push for digital assets in U.S. history.
And the Senate was racing against an August 7th recess deadline.
Right, and the entire framework effectively just stalled out.
Now, I need to be explicitly clear with you, the listener. Right here we are analyzing this strictly through the lens of market structure, capital allocation, and political leverage. We do not take sides on the political aisle.
None at all.
The development that caused the stall was a pressure campaign led by Senators Elizabeth Warren and Richard Blumenthal. They pushed the SEC to investigate Donald Trump's memecoin project.
The Trump token, yeah.
Right, citing an estimated $3.8 billion in investor losses compared to roughly $636 million in token-related earnings for the issuer.
And that specific investigation essentially became the leverage used to halt the broader negotiations. The core fight stalling the Clarity Act really comes down to 2 major sticking points.
What are they?
First, should senior government officials be restricted from operating or profiting from digital asset projects? And second, which is far more critical for the technology itself, does decentralized finance inherently create a money laundering loophole?
And that second point is the existential threat to the industry. The Blockchain Association and industry advocates, they've been fiercely arguing that there's a fundamental architectural difference between writing neutral, open-source software.
Right, just writing code.
Yeah, writing code versus acting as a financial intermediary that actually takes custody of customer funds.
Exactly. Because if you write the code for a decentralized exchange protocol and users trade directly with the smart contract without you ever touching their assets, are you a broker-dealer?
Doesn't seem like it.
But the current legislative pushback essentially wants to treat the software developers as if they are the bank tellers. And the impact of this standoff was immediate. The White House remained completely silent on a bipartisan ethics counterproposal from Senators Tillis and Gallego.
So the window just closed.
The legislative window closed, yeah. Prediction markets aggressively repriced the odds of the Clarity Act passing in 2026 down to a dismal 16%.
It is an incredible paradox. You have a multi-trillion-dollar technological framework that major institutions are building on right now, potentially derailed at the 11th hour by a proxy battle over a single meme coin's ethics.
It's wild.
And while Washington remains bogged down in gridlock, capital goes where it's treated best, and the technology simply continues to advance globally.
It doesn't stop.
No. On the exact same day the Clarity Act stalled, Circle announced the launch of its Arc mainnet, with founding validators, including behemoths like BlackRock, Visa, MasterCard, and Standard Chartered. TradFi isn't waiting for Congress to figure out how to classify software developers.
They're building the global payment rails right now, which highlights a really fascinating dichotomy for Thursday. While the traditional financial system is aggressively organizing, the decentralized ecosystem is currently embroiled in severe internal conflict.
Oh yeah, the Ethereum civil war.
We saw this erupt with the debate over Ethereum's proposed EIP 8361.
The Tapered Issuance Burn. This has sparked what can only be described as an economic civil war over the future of Ethereum's monetary policy. Let's break down the mechanics for the listener.
Sure.
Right now, when you stake your Ethereum to help secure the network, you earn a yield. The protocol issues new ETH to reward you. But this new proposal, championed by researchers like Justin Drake, introduces a mechanism that actively destroys or burns an increasing share of those validator rewards as more ETH gets staked.
Right, it tapers off.
Yeah, if 50% of all circulating Ethereum ends up locked in staking contracts, the net rewards issued to validators would drop all the way to 0%.
And you really have to ask why the network designers would intentionally want to pay the security providers less.
Right, it sounds counterintuitive.
It does. But the proponents of this burn mechanism argue it's an absolute necessity to limit dilution and protect the monetary premium of the asset. Their fear is that giant liquid staking providers, entities that pool user funds to state on their behalf, will accumulate too much power and effectively monopolize the network.
So it's an anti-monopoly measure.
Exactly. By artificially capping the rewards, the proponents believe it preserves raw, unstaked ETH as a neutral asset, rather than forcing every single user to stake their holdings just to avoid being diluted by network inflation.
Okay, I understand the theory, but let's look at the actual market mechanics of this. Because critics, including Avi's founder, Stani Kulechov, they are furious.
No, they hate it.
It kind of reminds me of, I don't know, raising taxes on everyone to stop a few billionaires, but only the middle class ends up going broke.
That is a brilliant way to conceptualize the centralization paradox at play here.
Because look at the unit economics, right?
Right. Let's look at the solo validators. The individuals running nodes from their own hardware at home to keep the network truly decentralized. They have relatively high capital and operational costs.
They can't survive on pennies.
No, they can't. If you crush the base yield of the network down towards zero, massive institutional staking operations can still survive on razor-thin margins because of their sheer volume and access to ultra-cheap capital.
But the solo guy gets wiped out.
The solo validator simply cannot survive. So, ironically, a proposal explicitly designed to prevent liquid staking giants from centralizing power could end up squeezing out all the independent operators, thereby centralizing power directly into the hands of the very institutions it was trying to constrain.
And it doesn't just impact validators, right? It threatens the entire decentralized finance yield curve.
Absolutely.
Because if the base risk-free rate of Ethereum drops to zero or fluctuates wildly based on a dynamic staking cap, the borrowing and lending rates across platforms like Agava or Compound lose all predictability.
And capital hates unpredictability.
Exactly. Institutional capital might flee to other layer ones that offer stable yield. Now, we should note for you guys listening, this is currently just a draft proposal. It has not been approved for the upcoming Hegota upgrade, but the philosophical divide is incredibly deep.
It's literally a battle for the soul of the network. Should Ethereum prioritize being pristine, non-dilutive money, or should it prioritize being a highly lucrative, decentralized computer platform?
It's a tough question.
It is. But while the Ethereum community agonizes over philosophy and neutrality and macroeconomic theory, other major players in the space are leaning entirely into aggressive, high-speed, on-chain capitalism.
Which brings us to Friday.
Right. Friday's massive shift in decentralized exchange architecture.
Uniswap going full vertical integration.
Yeah.
So the meme coin economy has been demanding better, safer infrastructure, and Uniswap basically delivered it by launching pools.trade.
A massive launch.
Huge. This is a zero-fee token launchpad built directly on the Robinhood chain, leveraging the brand new Uniswap v4 architecture.
And the mechanical upgrades here are just tailor-made to solve the pain points of the current market cycle. Because historically, token launches are plagued by predatory bot activity, right?
Retail gets destroyed by ME.
Exactly. Maximal extractable value, where bots front-run their transactions. Well, Uniswap's new platform utilizes these 4-hour crowd launches. It creates a time-weighted buffer that prevents insiders from bundling transactions and buying up the token supply in the very first block before anyone else gets a fair chance.
Leveling the playing field.
Right. It also features permanent locked liquidity and advanced anti-sniping tools.
But the true innovation, the reason this is so disruptive is the fee structure. Usually, a DEX takes a flat cut, like 0.25%, which goes to the protocol or the liquidity providers.
Standard practice.
But on pools.trade, that standard fee is split between the token creators themselves and an auto-compounding liquidity mechanism built via Uniswap v4 hooks. Uniswap Labs isn't even taking that cut.
Which is crazy.
And the market appetite for this was so voracious that traders actually tracked down the smart contracts and front-ran the official user interface. They generated $150 million in trading volume before the official website was even live.
It was a staggering display of demand. But the strategic play by Uniswap is what you really need to internalize here. Historically, Uniswap was the secondary market. A token was created on a launchpad somewhere else, liquidity was seeded, and then eventually trading migrated to Uniswap.
Right.
With this platform, Uniswap is moving down the stack. They are vertically integrating to own the token creation process, the initial liquidity formation, and the entire trading lifecycle from block zero.
We want the whole pie.
They want absolute monopoly over token inception. By offering a zero-fee model combined with their massive brand trust, they are posing an existential threat to every smaller launchpad protocol in the industry.
And the contrast in the broader market on that specific day was almost surreal. It highlights a deeply bifurcated ecosystem. On one side, you have retail traders aggressively utilizing this new infrastructure to ape into a meme coin called Cash Cat, which Robinhood officially listed for trading that same day.
Right, full Dujin mode.
Yeah, full Dujin. And on the exact same day, institutional flow data dropped, showing that BlackRock had quietly purchased over $478 million worth of Bitcoin over the course of the week.
It's two entirely different realities.
Totally different risk profiles, operating on the exact same technological rails.
And that bifurcation is exactly why this deep dive is so critical. You have to be able to track both the retail sentiment and the institutional plumbing simultaneously if you want to understand where the capital is flowing.
So let's distill all of this down for the listener. We have covered a massive amount of technical and structural ground today, from AI uncovering 3-year-old hardware flaws to BlackRock capturing stablecoin yield, stalled legislation in D.C., Ethereum's internal economic war, and Uniswap monopolizing token creation.
It's been a busy week.
What is the true signal here, and what was mostly noise?
So the undeniable signal of the week, the developments that will honestly shape the industry for years, are twofold. First, BlackRock's tokenized money market funds aligning perfectly with the incoming Genius Act.
Right.
This is the permanent bridge being built between traditional fiat reserves and digital asset liquidity. TradFi is officially the back end of crypto. And second, the Coldcard exploit proves definitively that AI code analysis is actively changing the threat landscape.
It's a new paradigm.
It really is. The era of assuming old, heavily audited open source code is inherently safe is over. The risk profile of the entire industry just shifted.
And as for what was mostly noise, Well, we have to classify the intense focus on the Trump meme coin ethics debate in Washington as noise.
Agreed.
And not because political ethics don't matter. They absolutely do. But because in this specific context, it was largely political theater. It was a proxy battle utilized specifically as leverage to stall actual, meaningful market structure legislation right before a Senate recess. The hyper-focus on one meme coin intentionally obscured the multi-trillion-dollar regulatory framework that the broader industry desperately needs to move forward.
Which dictates exactly what you need to be watching next. Keep your eyes on the White House over the coming weeks. Will they finally respond to the Senate ethics counterproposal before the legislative window fully closes for the year? Or will the U.S. just abdicate its regulatory role entirely?
That's the million-dollar question.
Exactly. And on the technology front, closely monitor how the Ethereum community resolves this EIP 8361 standoff. If core developers attempt to push the tapered issuance burn through without overwhelming social consensus, it severely risks fracturing the validator base at a critical moment for institutional adoption.
It is a high-wire act for network consensus.
It absolutely is. And I want to leave you with a final thought to mull over as you analyze your own risk exposure this week.
Give it to us.
We just watched AI uncover a highly specific dormant vulnerability from 2021 in a physical hardware wallet firmware, right? Leading to an $89 million exploit today.
Yeah.
Well, if AI can systematically dissect and exploit physical hardware firmware that has been in the wild for years, what dormant, complex vulnerabilities is it currently discovering right now in the foundational, immutable smart contracts of our largest decentralized finance protocols?
Wow. That is a deeply sobering thought, and it's exactly why we have to keep our focus on the underlying mechanics and the architecture, not just the daily price action.
Absolutely.
Thank you for joining us at the table for this deep dive. If you want to stay ahead of the curve, understand the second-order consequences, and get this level of market analysis delivered straight to you, make sure to follow NiftyNoon on X and subscribe to our newsletter on Substack. We sift through the noise so you don't have to. Until next time, stay sharp.